Earlier this year, the Australian Treasurer Jim Chalmers handed down a budget with some pretty serious implications for the country's economy. This budget came at a difficult time for the country as it currently navigates a fuel crisis, a housing crisis, a cost of living crisis, just a lot of crisis. But of all the new changes in the budget, none have found themselves in the media spotlight quite like the housing changes, which have seen
broken promises.
This is really going to change things.
Was Jim Chalmers reversing monopolies?
Mixed reactions, to say the least. And when the details were announced, some were skeptical if the budget would actually end up meaning anything at all. Well, less than a month on, we might have our answer. But just for some very brief context, take a look at this graph. You see that massive jump right before the turn of the century? Yeah, that was the Y2K bug happening. Kidding. See, in the year 1999, the Howard administration scrapped the old housing taxation system that indexed based on inflation, which was generally considered less beneficial for investors. Instead, the country swapped to a flat 50% capital gains tax discount. For those unaware, I'll give you a very quick walkthrough of what a capital gains tax discount actually looks like. By itself, CGT means you only pay tax on the added value to the asset. So, say for example, you buy a house for $1 million. Congratulations. But say a couple years later, you sell it for $1.5 million. Well, you only end up paying tax on the $500,000, with the rest of it being totally ignored, which obviously sounds pretty awesome. However, a capital gains tax discount of 50% means you only end up paying tax on 50% of that. So by the end, you're only paying tax on $250,000, and that $1.25 million is practically forgotten. Or forgotten by the government at least. I'm sure you're very happy about it. This by itself obviously sounds great for an investor, but pair it with the decline in historically high interest rates, and then housing became a practically irresistible investment, if you had the money. From here, housing prices pretty consistently soared from these new tax changes, save for a few disruptions. However, as I'm sure you're aware, things have only gotten worse in recent years. In 2025, for example, housing prices grew nationally by 10% in just that year, with those numbers being even higher in cities like Brisbane, which is set to host the Olympic Games in just a few short years, and Sydney, which is, Sydney. So where does that leave us today? Well, with the CGT discount sidelined in favor of the new old indexation taxation system, plus interest rates on the rise again, it's starting to look like maybe investors really would be better off in the stock market after all. Then, pretty shortly after the budget dropped, the Australian Financial Review released a piece saying that housing prices were expected to fall by 10% over the next year, which is perhaps one of the biggest market corrections in recent history if it proves true. Currently, as of recording, it is June 10th, not even a month later, and reportedly, house prices across the country have already dropped by almost 1%. This is alongside auction clearance rates dropping to about 50%, which is equivalent to near pandemic levels. But there's more to this story. See, Jim Chalmers' new housing changes have a bunch of what ifs and howevers and buts and blah 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 blah. But one of the really interesting points is that investors who buy a new build can pick between the new indexation system or the old CGT system. Meanwhile, established builds are pretty much set to use the indexation system that investors really aren't a fan of. While this might sound a little bit silly and a little bit reductive, there's actually something to it. See, instead of investors crowding across every single auction to every single house ever, shift their attention and start putting pressure on new builds, which could in turn, with some stimulation, drive property development up. Additionally, the possibility has been raised that older investors who are getting closer to retirement might just cash out now and sell their homes. You know, those established homes that investors don't really want, that homeowners can actually take benefit from. So now let's zoom out and see what this actually means. Well, it's hard to say. Like I said, it's only been a month, and to make massive claims of a crash or sweeping changes or whatever else would be a bit generous. This is undoubtedly a topic that will need to be revisited in 12 months' time, which is why you should subscribe. But at the very least, it looks like we're going to see the market smoothing out, with house price growth per year reducing to more manageable levels. But ultimately, investors are only part of a battle. The country still suffers from massive issues, such as incredibly long construction times, which make building new houses a massive struggle. Regardless, it's still pretty significant for prospective home buyers. But of course, this could in turn be of concern to current homeowners, especially boomers who might be hedging their retirement on these houses. Now, of course, seeing your assets go down with the big red arrows and the thumbs downs and the frowny faces is never fun. especially when it's $1 million asset. But at the end of the day, something's gotta change, and that means that maybe somebody's gotta lose. I mean, the current Australian homeless population is almost equivalent to the entire population of Darwin. Millions of Australians are currently at risk of homelessness, and on top of all that, we're currently in the midst of a cost of living crisis that means saving for a home deposit is like a Sisyphean task. At the end of the day, housing is a human right, and investing is little more than a privilege. Thank you so much for watching. I hope you enjoyed. If you did, be sure to like and subscribe. If you have anything you'd like to say, feel free to comment down below. This has been Envy.